Good weekend all. Ira Epstein with your agriculture wrap-up, and this is your weekend edition for December 13th, 2019, just after 1:20 p.m. Central Time. Now, as we look at these markets, you know, it's all been about U.S.-Chinese trade. I wrote a rather lengthy synopsis, if you will, as to, for my Sunday update, as to what the viewpoints of China are in the U.S. Let me say this. We've reached a deal, but you and I don't know the exact details of it. That will come out. Yes, there'll be grain purchases, energy purchases. Yes, it touches on intellectual property rights. No, it doesn't force China to buy $50 billion a year of goods. They claim it, but when you read the Chinese point of view, you get a little away from that. That's one of the reasons the stock market gave up its bigger gains. Not that the market won't go for those highs again. We need the details. And in the details, you didn't get enough to stop the metals from rallying. You can see gold's up rather smartly. Here's another market that's concerned about it. Bonds and notes. They're taking back some of what they gained. But on the energy sector, up, and why not? It takes the weight off our shoulders. We know that come December 15th, the U.S. and China, at this point, no more tariff increases. If anything, they're going to reduce tariffs from both sides, and they're agreeing to go to work on the other phases. Now, who knows how real that is? Let's find out what this one's all about before we get too far away. As we look at a monthly area chart of closes of soybeans, the one thing that stands out to me is for the time being, we're staying over the red line, which is the 18-month moving average of closes. That gives the market as a whole a bit of an upside bias. When we take a look at a weekly bar chart, we were up for the week 17 cents. You can see how the market came off those lows, giving me still reason to believe that what we saw in this break last week was the harvest low. As we come into the chart and we look at the swing lines, this is a chart without them. When you put them on, the way that the swing line is drawn, it always looks at the previous bar. And the indicator, as I wrote it, looks to see should the line it draws be to the upside or downside. Looks for higher weeks, lower weeks, inside weeks, outside weeks up, outside weeks down. That's what it's looking for. So right now the trend is down. You have lower highs. That's the definition of a downtrend. You break that if you take out 929 3/4. The market is stuck in an area here where it's been fighting at the 18-week average, almost 4 weeks in a row. It finally got up to the 100-week average. On the way down, it had stalled here. You can see it was playing around there. So it's gone back to what it stalled at. The other area that I look for is where the Bollinger Bands, and they're further away. Bollinger Bands are an algorithm designed to keep the market trading within them 95% of the time. If you go to 100%, they never come out. So you want it 95%. And one of the things I look at them is when they're first hit, be it to an upside or to a downside. I'm looking for that to be the first support area. Now, a lot depends if you've got a narrow band like this or if you're much wider the way you are right here. That's very important, understanding where you're at when you first hit the band. But for the time being, here's how I'm viewing this. You still have the downtrend. It's nullified because prices are over the 18-day average, which gives them an upside bias, and momentum is flattened itself out. So we have a market that's sort of just churning right here, got up to good resistance at 909.5, the 100-week average. In the meal market, we have been stuck at this 18-week average for the past roughly 6 or 7 weeks out of, about 6 weeks out of 7. And you keep hitting that number, not moving either side. Overall, the trend is what? Lower highs, lower lows. Down. The settlement price at 292.60 is under the 18-day average. Therefore, the bias is down and momentum is still pointing down. Therefore, I continue to think the pros are selling short into that 18-day average, which stops over this rally high that they had right there at 307.90. Now, even getting up there would be a problem for the bulls because you'd be right into the Bollinger Band resistance. The powerhouse of the market continues to be the soy oil. This is the market that once in August, it got itself over that 18-week average. It has kept the traders in what? A bull mode. Remember, if you're over that 18-week average, you have a bullish bias. That's what it's done. Admittedly, it's hit a bunch of times the Bollinger Band, backed off from them, had a recent breakdown here, but this is a new high for this whole move. This is still a market that has a lot of upside to it left in it possibly, but certainly it's saying, no, I don't want to join you on the bear campaign. In the corn market, it's still bearish. You have the pattern of lower highs, lower lows. You finished poorly this week. You didn't go anywhere. You were down a quarter cent, but you didn't get up and go anywhere. And the resistance that it hit last week when I had done this, the combination of the 118-day average was just too much for the market. It couldn't get anything through it. Even if this market were to rally smartly here, the fact that it has a lower low than last week, if you got over these numbers, you could not end up in a bull pattern. That's important to me. In the wheat market, you have a lower low, higher high pattern. But since right here, since September, this market has stayed over that 18-week average. So the bias has been up. The market's had a fairly easier time of getting to the Bollinger Band than the other markets. It has held very well the 18-week average. It's got a friendly bias to it. In the cocoa market, cocoa's at this funny spot in the chart. Number one, momentum starting to wane. It's starting to pull back on you, getting back under the 80 level. Number two, you have the pattern of higher lows, higher highs. Number three, from this sideways action, the market made its challenge of the upper Bollinger Band. I teach in my charting course that when you hit that, generally the first time, be careful. Markets often like to fail against it. And that's what this market has done. Now, if this market takes out on the weekly chart 2590, it ends up with a pattern of lower highs, lower lows. Momentum will most likely, you'll see the red line even go further down, and this becomes a potential target. Stay above that number, and the bulls have control. They're still fighting with momentum, but it's not turning enough down to run in front of price as I'm seeing it. Sugar market, still bullish. Higher lows, higher highs. I'm going to again teach you this. When you're over this number, the red line, you should have a bullish bias. You always look on your charts, what's that doing? Under a bearish bias. Longer term charts keep you, is another type of a filter. Upper Bollinger Band, 1374, you're 7 points away from it, momentum still up. Coffee market, be careful. The daily chart, not the weekly, is throwing out a pretty big reversal. Be very careful. There's a gap in the chart, I think, from right here, this 126.15 to 127.30. See that from that high to that low. Don't be surprised if the market tries to fill it. Most times gaps are not left in charts. This market has gotten ahead of itself this far over the upper Bollinger Band. Momentum is still to the upside. Momentum, when I look at it on a weekly chart, is either up, down, or flat. This one's still to the upside, hasn't begun turning down. Cotton market. Cotton's a beneficiary of a U.S.-Chinese trade deal. And you can see how the market ran. It got up to 67.80, just missed the upper Bollinger Band, momentum up. Trend has been up. You didn't need this. You've had it. Higher lows. Now you cleared it, higher high, right up to that objective. Cattle market joining the hit parade to the upside. It's been staying since September over that 18-week average, but it's consistent in the pattern of higher lows, higher highs. No reason this market can't continue in that pattern. I would think beef's a winner on the combination of U.S. demand, Chinese potential demand, all that is going on, and good packer margins, by the way. In the lean hogs, even with the U.S.-China deal, you still keep this market underneath that 18-week average. Momentum is still pointing down, trend down. Until it's over, it ain't over. This chart is still in the bear camp, even with all that talk. So I look at it, try to figure out where you go, and here's where I'm at. This coming Sunday, December 15th, this sale is over, and you're not going to get another shot at it. What it includes is my charting course and any of my one-year subscriptions. So you buy a one-year subscription to my research, You decide if that's worth it to you. The course is $179.95. I throw the course in, and you can give it as a friend to a friend. You tell us when you want the course to begin. We'll set that all up with you, and then once they start, there's 30 days to the course, and that's how it runs. $179.95 value. They will learn the trading technique that you see me employ here. How do you find out more? Go to our website, www.iraepstein.com. When you get to it, go to the word research. It explains the different packages. It's a one-year package, any of them. If you want to find out about the course, simply go under the word education on the website. Want to make life easy? Before 4 on Friday, call my staff. They can work with you right on the phone and get you all set up. I'm Ira Epstein. You have a great weekend, and I'll see you all come